The first thing that we do when it comes to market, obviously, is spotting out your highs and lows, no? So the market will be ranging within those highs and lows. Since you know that, I'm just gonna be fast. And then we also have structures, which I'm sure you're aware of. Could be an ascending structure where the market is going up in direction, or a sideways channel where the market is rather flat. Also, the last one is the descending structure, no? So those are the three different types of structures that we get in the market. We have an impulse. The market moves in two phases, which is an impulse, correction, impulse, correction, impulse, and so on. And we have two different kind of corrections. You know that, right?
Yes.
Okay, so obviously the first one is a continuation correction where the market continues, yeah. And then the second,
reversal correction.
yeah, so the reversal correction would look like an ascending structure where it reverses and then goes the opposite direction. And same thing as the one that goes down, the descending reversal to the upside, opposite direction. So since you're only struggling with entries, let's just quickly check out NASDAQ now. So what we see, the first thing that we see is that the market has been going up, giving us this nice impulse. You're with me now?
Yeah, I'm listening.
Okay, and then right after the impulse, you can see we have this nice corrective movement here in the 4-hour time frame. So we focus on, when it comes to entries, you don't focus on the impulse, you focus on the corrective movement area, no? Which is basically your structure. So what we do first is, traditionally you can draw your lows, your highs, and then from that point, that's when you start to check out the resistance and the support of your structure. So the key thing about structures regarding entry, now, a structure moves within your trend lines. In case of a buy, right now we're looking at an uptrend, since the market gave us an impulse from the downside to the upside. Now we are in a correction, which means this correction is a continuation correction for the market to keep pushing up, right? So the thing is, when you want to look for buys in your correction, you must focus on the support of your correction, which is this trend line that we have right here. So your trend line, the most important thing is it must have 3 touches. The third touch being the highest probability. When it comes to the third touch, that's when you must start paying more attention, because that's where you would want to execute your entries, because the third touch will forever have the highest probability. Because for an example, let's say you pick the second touch on your trend line as a double bottom, but you can see from that point the price went back down. So which means if you did buy at the second touch and you put your stop loss right below the movement, you can see you got stopped out before the market created the third touch. So the third touch is the one that always has the highest probability. That is the number one rule when it comes to your entries. So with this one, since we know that the market moves in an impulse, then gives you a correction, and as the correction is forming, you patiently wait for the third touch, which will be right here, since we already have these two. So from that third touch, what you'd want to see is the market reversing or rejecting, no? So that's when reversal candlesticks come in. Are you aware of reversal candlesticks?
Yes, dodges and all.
Good. So at your third touch, you want to see those candlesticks forming to give you. There's this thing called confluence. So confluence is when the the price is giving you more than one reason to,
To enter.
yeah, basically. So you need as much confluence as you need. So the first confluence that we had is the correction itself prior to the impulse. So which means it's a continuation correction. So that's the number one confluence, that the price is going up for a buy, no?
Yes.
And then the second confluence is your third touch. So third touch, when the third touch forms, now you have two reasons to buy. And then within your third touch, you want to spot those reversal candlesticks and so on. That's your third confluence. And just look at the third touch. It's at a very key point regarding this support.
Double bottom.
Yeah, double bottom support. It's a key area. So we're gonna scale down to a 2-hour time frame. Okay, let me just remove this zone. So when you see the price giving you this confusing choppy movement, you can just simply go back to the bigger time frames for it to be laid out more perfectly. So you can see now we don't have a lot of noise. So what you want to do now, when you spot your reversal candlesticks, you can see the first reversal candlestick that we had, let me just remove this, is this one right here, right? We can both agree this is a reversal, right?
Yes.
So from this point, when you receive your reversal, that's your fourth confluence. Like, okay, I have 4 reasons to buy, but if you're still not sure, you can still wait. So the thing is about the reversal candlestick, right after it forms, in a case of a buy, you'd want to see bullish candlesticks to confirm the buy, right? So when it comes to those bullish candlesticks, you must at least have 2 bullish candlesticks in a row prior to the reversal candlestick. So this is our reversal candlestick right here. Let me just zoom in. So that's our reversal candlestick. So from the point of the reversal candlestick, we want to see bullish candlesticks. So you can see we had our first bullish candlestick right here. You can see that, right?
Yes.
So the thing is, you must consider the size of the candlestick. Hold on, sorry, let me just close my sliding door. It's noise outside. Okay, so the size of this candlestick is so important because it will tell you how much momentum the price has within the direction that you're anticipating. So now we're anticipating a buy. We are having our bullish candlestick form, and if you can see the size of it, it's way bigger than our reversal candlestick.
Yes.
So right after that first bullish candlestick forms, you wait for the second one, which is this candlestick. This is the second candlestick. And what you would want to see with the second candlestick is the same direction. It must give you the same characteristics. It must be a bullish candlestick. 2 bullish candlesticks in a row will be enough confirmation for you to enter the buy in the case of the bigger time frames, because in the smaller time frames 2 candlesticks might not be enough. You'd have to wait for maybe 3, and in some rare cases 4 candlesticks if the candlesticks are not big enough. So this one, since these ones are big, 2 will be enough, and since we're in the 4-hour time frame, which is a very high time frame, they are so significant. So we have 2 bullish candlesticks right after the reversal. So what you do from that point, what you do from that point is now you can scale in your entries. So let me just go back right there. So you can kindly open at the opening of the 3rd candlestick, which will be this point right here. And then when it comes to your stop loss, you must set your stop loss below the lowest point of that 3rd touch. So this is the lowest point, this wick right here. So you just set your stop loss right there, as you can see, and then you scale up. So simple as that. The price bought from that point all the way up, right?
Yes.
Okay, fine. So that's how you would have got that entry at the 3rd touch with the confluence of this nice support area and this support area of the structure itself on the 3rd touch of the trend line with reversal candlesticks followed by bullish candlesticks that happen in a row. So that's how you would have entered that one. So let's scale back to the 1-hour time frame. So from that point, for you to catch maybe other entries, if you didn't catch this one right here, you'd wait for the market to give you a nice impulse and then a correction. So that correction, you're going to continue with the price going up. So let's look for these corrections. So you can see here we have a bit of correction, but it's very small compared to the size of the impulse, right? So this would, in my opinion, it would be more of a gamble because the size of the impulse is way bigger. It's so big. But you could have used this as your first correction if you had the capital to maybe set a risk entry, right? And the same concept works. So if you obviously point out your support, and then this is not necessary, but you can also get your resistance. But then in the case of a buy, the resistance doesn't really matter unless if you want to trade breakouts to the upside. But then I would leave that empty because you were only focus on the support. That's where you're gonna take your entry. So when the market buys, you focus on support. When the market sells, you focus on the resistance. Yeah, so same thing applies. So let's count the number of touches on our support. This would be the first one, second one, and then the third one. So remember what I told you, the third one always has the highest probability. You are safer waiting for the third touch. So we're gonna zoom in and look for reversals, the price showing some rejection. Okay, let's just zoom in. So you can see with this one, this was our first reversal candlestick, this one right here now. Let me just circle it so you can see it properly. Right there, you can see it now.
Yes.
Yeah. So you can see this one was tricky because right after the reversal candlestick, we had a nice bullish movement followed by another bullish movement. So in most cases, you would have entered at the opening of the third one, but then the price still went back down, right? It probably would have stopped you out. So when you want to confirm such movements, you just go up your time frame to see if everything aligns. Hold on. Where are we? Okay, we're right here. So we'll just scale up to the 30-minute time frame, and you can see that in the 30-minute time frame, it tells us a different story. Instead of 2 bullish candlesticks, we have 1 bullish candlestick. You see it now, right after this nice
Yes.
reversal. So what that tells you is that there's not enough confluence because we only had 1 bullish candlestick form instead of 2 forming in a row. So you would have just waited and ignored this reversal candlestick and just wait for another reversal candlestick followed by 2 bullish movements, 2 bullish candlesticks in a row. So this was our last reversal right here. And then right after that, we had this huge bullish candlestick followed by another bullish candlestick. Just hold on. So this tells you, okay, now you can enter. You buy at the opening. Set your stop loss right below the lowest point of your third touch, which is this wick right below the support. And then you scale up. You're still following, right?
Yeah.
Okay, so it's just a repetition of what we did in the bigger time frame. And then you just repeat the process all over and all over. So you can see with the next correction phase, right after this bullish movement right here, we had another correction. So it's the same concept. You figure out your support. But with this one, the price never really touched on the third touch. So for you to be safer, it's either you could have just extended this and then just count this as a touch, or you could have used the inverse head and shoulder. Hold on here, my mouse is just doing weird stuff. Okay, so you could have used a head and shoulders instead if you were worried that the price won't reach this zone. But usually you should form your zones a bit thicker so you can let the price touch it. So with this one, the price could have went back to that 15-minute time frame and see what is going on there. Hold on. Okay, let me just remove this pattern. And one thing that I forgot to tell you, you must check how the price gets to your third touch. So the price could either get to your third touch just like a straight price movement. Hold on. Let me use this instead. It could get there as an impulse and then reverse to the opposite direction, or the price could get there correctively and just form some kind of correction and then go back up. So those are the two ways the price would get to your third touch or your entry point. So let's just look at how it got to our third touch here. Let me just mark all these touches. So this is the third touch that we're anticipating. So you can see the price didn't just go all the way down without disturbance. It got there correctively by going sideways, right?
Yes.
So what you do is you have to pay attention to that movement. You draw your resistance and support of the movement. So now what we have is something very interesting. Even if you didn't adjust your zone or your support, even if it was still right here, no? But just this market movement alone, it would tell you that, oh, we had this impulse, now we have this correction. And what kind of correction is it? It's a continuation correction. Yeah. So that's why the price didn't reach this level. Instead, it corrected another structure. So how would you have traded the structure? It gave you, let's count the number of touches. This was the first touch on our structure, second touch, and the third one. Third touch, highest probability. So with the third touch, you pay attention on how the price rejects. It rejected by these two long wicks. And then even if it's not a perfect reversal candlestick like the ones we had before this one, you just know that, okay, fine, it's on our support, rejected by these long wicks. The price touched the trend line, went back up, touched the trend line again, went back up. And then what do we do next? We wait for bullish candlesticks to form. So we had our first bullish candlestick right here, a very long bullish candlestick. As you can see, it reached all the way here, but then rejected to close midway. And then you wait for the second one. Even if it feels like you're missing pips from getting your perfect entry around these areas, it's still the safe way to do it. So you wait for two bullish candlesticks to form and then open at the third opening, which is that point. And then you set your stop loss right below the lowest point, which is right there. And then you just scale up. And you can see the price never really touched our support. I mean, our trend, stop losses. Every single time, it didn't touch our stop loss. It didn't even bother coming back to our stop losses. So it's the same concept. Third touch always has the highest probability. Always high. It's always high. So another correction, draw your trend line. Get your trend line right there. So since this structure is a bit big, you would want to scale up and move on from the 15-minute time frame and maybe try to check it out in the 30-minute time frame. So you can see we have 3 touches on our support. So this one is interesting. So I'm gonna show you the reason why you put your stop loss below the lowest point of your third touch instead of at your third touch. at the low of your third touch. You put it below the lowest point. So let's just zoom in on our third touch. So obviously, entering markets or trades the way I showed you now, you would have considered this area as your third touch. This point right here. Fine. The price rejected, gave us two bullish candlesticks right there, as you can see them. And then you place your buy right there, all the way up. So when it comes to your stop loss, this is where it's important, because if you don't follow this, you'll probably get stopped out. So you put it below your lowest point at your third touch, which is right here, just by a few pips. So you can see the price went back and you were in the red, but then it never touched your stop loss. You can see that, right?
Yes, I can.
Yeah, so you setting your stop loss below the lowest point will save you from such things where the market goes back down, maybe for like a double bottom in this case. And say you were watching the market play out and it bought and then went back down, but then it never touched your stop loss, so you're still within the trade. So you watch what the market does, whether it's gonna break to the downside. Damn, we're running out of time. We have 10 minutes. It's fine. But then the price rejected and went back up. So what you do when this happens, you're gonna set your zone right there, because since you know this is a nice zone, the price went back down to retest the zone by giving you a double bottom. So what you would have done with your entries that you entered right here, you enter more when this
candlestick.
Yeah, when this double bottom finishes to form, by following the same rules, by waiting for the market to reverse and then give you two bullish candlesticks, and then you open, and then you enter at the opening of the third one. So right here you would have had two positions that you would have entered, which is good. Since this double bottom, it also adds on to your confluence, to your reasons why you should hold your buy, because we have a double bottom at the third touch and it's still playing according to our guidelines. So you would have had two entries right here, the first one here and then the second one at the second leg of the double bottom. So, and then same thing, you set your stop loss at the same areas, right below your lowest points, right there, and then you just hold until you take profit. So you can see we're doing the same thing all over again, from the big structure to the smallest flags or corrections to the medium corrections. Same concept. Third touch, you focus on, in the case of a buy, you focus on your support areas. That's where you're gonna enter your trades, and you wait for your, your reversals. After reversals, you wait for at least two candlesticks in the bigger time frames, in a maybe 15-minute time frame, or you're trading 10 minutes, 5 minutes, at least wait for 3 or 4. If they are too big, 3 will do. So the same thing just keeps happening and happening. Yeah, so that's what counts when it comes to when it comes to entering positions, because you need to be very safe and protect your account by using stop losses, and you must be smart by setting your stop loss. You can't just set your stop loss at your entry. You must put it below the lowest point of the third touch, not at the lowest point of the third touch, but below it. So Yeah. Do you have any questions? Because we have 6 minutes left until the session ends.
Yeah. So how would I know if for example, like if it's gonna reverse?
In
I don't know
terms,
if you understand. Like if it's gonna reverse.
like for an example, you were willing to buy here, but then the market dips,
Yes.
or okay. So when it comes to that, nah,
Yes.
okay, let me just erase this. Okay, so the market won't give you the bullish candlesticks. Instead, like let's say for an example, we're focusing to enter here. The market will just keep giving you red candlesticks while going down, red, 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 red. So it will invalidate this entry point because now it broke it, and the price just kept giving us red candlesticks instead of a nice reversal and two bullish candlesticks. The reason why we use two bullish candlesticks is to avoid the market just giving us false entries and it just forming more red candlesticks to the downside beyond our entry. So that's how you would have avoided the market just going down. You understand?
Yes, I do.
Yeah, so these bullish candlesticks will save you from the market just keep pushing down by giving you more red or bearish candlesticks. So that's why we wait for two bullish candlesticks in the case of a buy, because from that point we'll have enough reasons to believe that the market has reversed and it started to go up by showing us the momentum of these two bullish candlesticks.
Okay, I see.
Yeah, is there anything else that you would like to ask?
No.
Okay, so what you should do now until our next session. Our next session will analyze more charts, because this one we just looked at one chart just for you to have an understanding of how we find the structure, find the entry point, and how we enter from the entry point. So what you should do is just try to spot out these kind of setups, whether it's a bullish correction at the third touch. Look out for your reversals, look out for those two bullish candlesticks in the case of a buy, and then the opposite just goes for the sell. It's the same thing but just in the opposite direction, right?
Yes.
Yeah, so yeah, our next session you will probably have to share your screen, and then I'll let you analyze, and then I'll fix your mistakes. So, but then I'm sure it'll be easier since you know so much about, structures, candlesticks, and so on. So just try to practice what I showed you. You already have the video recorded, no?
Okay.
You recorded the session, right?
Yes, I did.
Okay. So it's fine. Just try to practice what I showed you. Remember, the key thing is when it comes to a buy, your correction, you focus on the support side of it, and you wait for 3 touches. Third touch is where you look for reversals, and then followed by those bullish candlesticks, and then that's when you enter. So yeah, until our next session, man. I'm glad that you already had like some kind of background. You are well equipped. It seems like it's easier for you to understand what I was showing you. So I'm sure you'll learn fast when it comes to entries, but it's nothing really difficult, man. As long as you spot your corrections, you focus on the third touch, highest probability, and you'll be fine. So yeah, I don't have to send you this recording. You have it on your side, no?
Yes, I have it.
Okay. Nah, it's fine. just practice until our next session. And if you have questions during the week or until our next session, just send them to me on WhatsApp, and then we'll just chop it up there until our next session. That's fine.
That's what's cool.
Okay, all right, cool. Now we'll talk, no?
Sure.
Sure.